Many investors are attracted to the stock market because of the potential for high returns, but the truth is that stocks come with a high level of risk. The value of stocks can be very volatile and unpredictable, and investors can suffer significant losses if the market takes a downturn. Bonds, on the other hand, are considered a safer investment option. When you invest in a bond, you are essentially loaning money to a company or government entity in exchange for a fixed interest rate. Unlike stocks, the value of a bond is not subject to the same level of market fluctuations, and you can usually count on receiving your interest payments on a regular schedule. But safety is not the only advantage of investing in bonds. They can also provide a steady stream of income for investors. This can be particularly attractive to those who are looking for a reliable source of passive income or who are nearing retirement and looking for more stability in their investment portfolio. Another benefit of investing in bonds is that they can help to diversify your portfolio. By investing in a mix of stocks and bonds, you can spread out your risk and potentially reduce the impact of any market fluctuations. One important factor to consider when investing in bonds is the interest rate environment. When interest rates are low, as they have been in recent years, bond prices tend to rise. This is because investors are willing to pay more for the fixed income that bonds offer. Conversely, when interest rates rise, bond prices may fall as investors seek out higher returns in other investments. Another important consideration is the credit quality of the bond issuer. Bonds issued by governments or highly rated companies are generally considered less risky than bonds issued by less creditworthy entities. However, higher-risk bonds often come with a higher potential return, so it's important to weigh the potential rewards against the risks involved. It's also worth noting that there are different types of bonds, including government bonds, corporate bonds, and municipal bonds. Government bonds are issued by national governments and are generally considered very safe, while municipal bonds are issued by local governments and can provide tax advantages for investors. Corporate bonds are issued by companies and can offer higher returns, but come with greater risks. Finally, it's important to have a plan for your bond investments. Some investors prefer to hold individual bonds until they mature, while others prefer to invest in bond funds that hold a mix of different bonds. Both approaches have their advantages and disadvantages, so it's important to consider your investment goals and risk tolerance when making a decision. Bonds can be an attractive investment option for those seeking safety, stability, and income. However, like any investment, it's important to do your research, diversify your portfolio, and have a plan in place. By following these principles, you can build a well-rounded investment portfolio that can help you achieve your financial goals.